right. Welcome, everyone. I am Brandon Zero, a senior reporter at Mergers and Acquisitions magazine. I am joined by an all-star panel to discuss the changing nature of deal making in a high valuation environment. I'll throw it to the panelists to introduce themselves. Miguel, do you want to kick off?
Yeah, absolutely. My name is Miguel Tejeda. I am a VP on the investment team at a firm called Motive Partners. Motive is a fintech-focused private equity firm that does both late-stage growth and buyout investing. Robert?
Great. Good morning, everybody. My name is Robert Brown. I'm with Encore Consumer Capital in San Francisco. We are a small growth equity and buyout firm focused on the consumer products sector, and I'm a co-founder and managing director of the firm.
Nice. Well, as we all know, surging deal valuations have created a different type of environment for private equity and strategics alike. I just wanted to throw, I guess, as a first question, if we can get the conversation talking about how that presents a challenge for your deal flow. Are higher valuations something that has impeded deal-making activity for either of you? Do you want to start, Robert?
Sure, happy to. Would preface sort of any of my comments today with the fact that they're shared through a very narrow lens of a consumer products industry investor. So all we do is invest in consumable consumer products, so food and beverage, personal care and beauty, pet products, etc. Have invested across a lot of cycles over 20 years now. So dot-com boom and bust and the Great Recession, and obviously the depths of COVID and now the emergence from COVID, but all just within consumer products. So hopefully that slice isn't too limiting for folks. The challenges that we've seen, I think valuations are always a challenge. You're always forced to press the limits of where you're willing to go. But I think that the new thing that's been introduced, and particularly during COVID, due to a huge capital overhang and maybe less friction in deal making because so much is happening over Zoom, we're finding that speed is just much more crucial. And so valuation is always going to be a challenge, but you're having to move a lot faster. Now, service providers aren't even showing up on site to visit these companies, and things are expected to move much more quickly as opposed to more slowly. And what we're seeing now is a real shortage of resources. If you don't have the service providers lined up that are go-to providers who are willing to work with you, you're not really going to get anybody's help. So I think valuation is at an all-time high, no doubt, but some of those other factors are what I think is making things even tougher right now.
Interesting. And for you, Miguel, valuation specifically, is that impacting?
I think for financial technology broadly, a big piece of valuation and investing in the industry has been just adapting to secular valuation increases. So a piece of it is obviously sort of market driven, QE driven. We've had a huge bull market, but another piece of it is just fintech broadly. Increased reliance across the financial services industry has driven a lot of value in these assets. So I think for us, we've had to continually adapt to deploying capital in an environment where there may be a correction, but there are secular drivers that are more long-term that are increasing the value of these software businesses. So I wouldn't say it's necessarily driven any slowing in our deployment of capital, but we've had to come up with new strategies and ways to deploy it that keep us at a reasonable entry level.
About that, what kinds of strategies are you using to, I guess, benchmark against potential rising prices?
For us, it typically goes a few ways. I think the easiest one is structure. Earnouts, preferreds with minimum returns. I think those, even in this environment, have still been difficult because as more dollars chase the same assets, that not only creates higher valuations, but people are willing to invest in higher risk without that type of protection. Structure and investment, you typically need to have some level of differentiation that the seller is willing to sell, not at the highest price, and even with that structure. Another strategy that we've done is we like blending down entry multiples with M&A. there's a lot of really beautiful technology assets that you just have to pay up for. But to blend that entry multiple down, we've spent a lot of time pre-acquisition identifying more reasonably valued M&A opportunities. Typically, they're smaller legacy technology, ideally peripheral products to what the core platform provides, and it has sort of a sticky customer base you can cross-sell into. And as long as the integration is relatively easy, then you can begin to blend your entry multiple down at least within the first 6 months to a year. And then finally, I think that the biggest driver of keeping entry multiples down is just sourcing differentiation. And for us, and Robert, I'm sure you're the same way, being in a sort of a vertically focused investor, you tend to have some advantages when it comes to sourcing. For us, it's about network and strategy. We have a group of what we call industry partners, but they're really just highly experienced individuals in certain subsectors within fintech that are focused on a number of things. One of them is sourcing. Each of them has a massive network as well. And I would say as a proportion of proprietary deals in our pipeline, it's the vast majority of what we've done in the last 2 years has been all proprietary, or advantage deals, which is essentially when a deal's in a process and we go outside of the process. We also use strategy, which is when we don't think highest price will always win, whether it's offering connectivity into your portfolio companies through partnerships, or if there's a big rolling investor, a lot of times if you can convince them that you're going to be the best creator of value, the highest price won't always win there as well.
I agree with you 100%, Miguel. We have a phrase, we like to work with people who care who their partners are. And that makes a huge difference. We do a lot of the same things that you mentioned. I think just at 50% of the deals, when you look at the 35 deals that we've done over the course of the firm's life, have been truly proprietary, directly sourced, no sell-side intermediary of any kind. And you only get that by really pounding the pavement, getting out to the trade shows, sourcing deals directly, contacting entrepreneurs, and building a relationship over time. We've made a couple of investments where the relationship has been in place for over 10 years before we made the investment. And you got to be sector focused for that to work, and you got to be irrationally patient for that to work.
Yeah, absolutely. Brandon, you're on mute.
There we go. Sorry.
No worries.
Being irrationally patient and perhaps technophobic as well on my side, as that line from this panel. I'm wondering on your side, I mean, since you two are out there sourcing deals, obviously you talk about sort of a differentiated approach for how to get those deals in your sightlines. But I'm wondering, once you've sort of are negotiating and thinking about how to structure that deal, do you think as well about being disciplined on leverage as a way to control operating in this environment?
I think I can at least take a first shot at that. We are not the kind of folks to really redline leverage. Part of it is the nature of the size companies that we're talking about. I didn't mention that before, but we're investing in companies with as little as 10 million in revenue and up to about 100. Certainly on the lower end of that spectrum, we're rarely exceeding, between 3 and 4 times leverage. It's going to depend on the asset base, no doubt, but growth is going to drive our returns regardless of our ability to put leverage on a business. And so we're doing it to enhance returns as opposed to come in and maximize leverage on a company that might not be growing much and get our returns purely through debt pay down. So we're not the guys that are saying, okay, the debt markets are allowing us to do this now, therefore we can pay 2 times more for this company. It doesn't work that way in our world.
Yeah, echo all of that. Philosophically, we've been a pretty reasonable user of leverage. We've never used it to stretch on valuation or force a return threshold. And I think part of that is also half of our portfolio is fast growth technology businesses, where every incremental dollar spent on driving revenue growth versus paying down debt is you're always going to choose revenue growth in that scenario. It's just a higher return. But even in our buyout deals, where you would typically see more value driven by debt pay down, I think we tend to use slightly less leverage because every investment that we do is typically accompanied with a pretty detailed value creation plan, which almost always includes some level of reinvestment in the business to drive growth. And you'll typically see that over leveraging an asset puts those plans at risk, especially early on in the hold period. I think for those types of investments, maybe we can get more comfortable after 2 to 3 years relevering if we believe that we've hit all of our value creation plan initiatives and have increased growth from 10% to 15% or however comfortable we are. But typically we see it as a huge driver of value for us.
Interesting. So it seems like we've really run the gamut when we're talking about ways to sort of mitigate the risk from operating in this environment, whether it's being discriminating in terms of the kinds of deals that you're approaching to begin with, operating outside of a process, maybe less on the leverage side because of your approaches. But I do wonder, do you also think, if we're talking about the sourcing issue again, is there any geographic arbitrage that your funds look at? I know in the US, for instance, deal multiples are quite high, but do you look at different jurisdictions, different geographies as being places that might be more attractive to play in? Robert?
I think Miguel's going to have a more interesting answer because mine is no. So we invest only in North America. We find that because we're investing in smaller companies that require intense collaboration in order for us to really be value-added partners, we need to be nearby, and that really hasn't changed in a more virtual world. We want to invest in companies where we haven't met the management team in person and had a chance to develop close relationships. So we really stick to that. We do try and find angles for international growth. Particularly Asia has been very, very interesting lately and relevant to many of our portfolio companies. A decade or so ago, I would have said Europe and Latin America, but less so now, very focused on Asia in terms of top line opportunities, particularly for American brands. They're very, very much valued in Asia, but we will not invest in a company with a headquarters outside of North America.
So our portfolio is actually relatively similar, but it's North America and Europe. I would say one of the largest drivers of growth once we've acquired a platform has been focusing on Asia. But as far as finding reasonable deals from a valuation perspective in sort of non-financial center geographies, we've had a lot of success in that over the last 3 years or so. We acquired one business in Venice, Italy. We acquired another business or invested in a business in Ireland, both of which are fantastic software businesses. And I think what you'll see in Europe, which is interesting, is because a lot of the financial centers tend to be geographically constrained, London being a very good example. You'll see that the growth of a software business tends to be more limited by geography in Europe, given the language differences, the data regulation differences, et cetera. So you can have really good software businesses that haven't necessarily managed to fully expand outside of that geography. I think in the cases of the businesses that we invested in Ireland and Venice, both of them were actually already relatively deals in markets that aren't financial centers, just because there's just not as many eyeballs on those areas, but just as good talent.
That's great. I'm also wondering, obviously, one of the buzzwords that's percolating through deal circles right now is the prospect of inflation and how that changes the game. If we're already in a high valuation environment, I'm not really sure what the net effect of inflation is. I mean, historically, private equity has sort of seen that as a reason to pull back on multiples paid for assets. But I'm curious, has that begun to factor into your calculations and how you see the deal-making environment? Is it something that is top of mind at all? How does it rank, and how are you assessing the challenge that poses to you now. Robert?
Sure. I think you're speaking of inflation in terms of deal multiples and so on. We probably are thinking about that in a minor way. We're looking at a lot of businesses that are not yet at scale, and so by definition, you're sort of looking at revenue multiples, or that's the only handhold you have if they're not meaningfully profitable yet. And about half of our investments can be in that zone. And more growth oriented. If that's the case, we're always still looking at those businesses and saying, if we achieve our plan, what kind of a reasonable EBITDA multiple is going to be, sort of the lower end band of our exit strategy. So I think a lot of people get in trouble modeling multiple expansion when they're making investments, and we tend to try and avoid that and ground ourselves in EBITDA. On the P&L side of the equation, it's a deal right now. A lot of companies are paying more than they ever have for their commodity inputs, and I don't think you can make an assumption that that's just going to go away. How much worse can it get? I don't know. I think there is a limit in terms of what the consumer can pay.
And we don't necessarily incorporate either historical or forward inflation views into our entry multiple analysis or exit. I would say maybe it's not direct, but indirectly we do, in the sense that we do measure and look at sort of historical averages of multiples in that industry, through the cycle multiples. What can the low be? What can the high be? And typically, if we do pay above that historical multiple, we will model in some multiple contraction to get back to that mean. Or if we come in at that sort of average level, we will expect to exit at that average level. So we are incorporating inflation views by looking at just historical averages, but we're not explicitly looking at expected inflation.
Welcome, Karen. Do you want to introduce yourself maybe? We're talking about the impact of inflation on the current deal-making environment. Maybe you could pivot into talking about that as well.
Sure. Sorry, guys. Technology issues, as usual. So, hi, everyone. I'm Karen Ness here. I'm an investment analyst in the private equity team at Aware Super. Aware is Australia's second largest superannuation fund and manages about 150 billion in assets. Our member base is mainly public sector workers, so doctors and nurses and police workers. And the private equity program is about $5 billion in size. We invest across buyout, venture, and growth, and about 80% of the portfolio is offshore and 20% locally here in Australia. In terms of, sorry to just jump in on your questions midway, I'm sure there's sort of the flow going. I guess our objective is to try and beat public markets rather than generate absolute returns. So we're not overly focused on trying to estimate inflation per se. Having said that, we are mindful that the high growth tech stocks in particular have benefited significantly from falling interest rates. Will likely be more sensitive to an inflation shock if the current environment is more of a permanent one. And so we do keep an eye on our overall tech exposure relative to public markets as well, just to manage that risk.
Great. I did want to, there was a question that I had earlier that I was sort of sitting on in hopes that you would join us now that you're here. I wanted to talk a little bit about co-investment opportunities. I know that's something that you probably work in the most, Karen. And I'm curious, how do rising valuations play into your co-investment universe now?
Sure. So, I mean, our expectation at the moment is that any co-invest opportunity we see is likely to be at an elevated valuation. But we need to be able to invest through market cycles. And that's really been validated over the past several years, as many transactions that we thought were at high valuations then a few years back have performed very well today. That said, in the current environment, we're probably a bit more focused on understanding the GP's valuation, value creation plan. We really want to see the key drivers of returns being EBITDA and revenue growth rather than obviously multiple expansion. And in most cases, we're testing the sensitivity to multiple contraction on exit as well, just to see the impact on base case returns. In terms of valuation, we really want to understand valuation relative to the underlying growth of the business, obviously. And we're probably being in this environment just a little bit more cautious with regards to the leverage levels that we're seeing. I think we're seeing leverage levels creep up significantly. We've seen sort of, above 5 times on a number of deals, and we're just a bit more cautious and uncomfortable at accepting risks at this level. We're just cautious that the reliance on cheap debt is more of a macro play. And again, going back to concerns of a rising inflation, do we want our managers to be betting on the verdict there?
Interesting. Miguel, Robert, I don't know if you offer co-investment opportunities as well. If you can speak to how that maybe changes.
Sure. Yeah, absolutely. As a small fund, we have a $260 million fund. We're writing equity checks out of the fund from kind of 10 to 30 million, and we have larger equity check opportunities with some regularity. I think that LP co-invest is a great check on your deal enthusiasm. You can have sell that multiple to your LPs, and so we really appreciate having our LPs sitting around the table and helping us think through things, and always enjoy having them alongside us as part of the diligence process and make sure that they're seeing things that we're not seeing. So it's a great tool and allows us to stay small and focus on the deals where we see the most value. And occasionally, if we're looking at a company with 8 to 12 or 14 million dollars of EBITDA, we could never really do all that out of the fund ourselves, especially if it's a complete buyout without any rollover. And being able to do deals like that where we may have some sort of a proprietary angle with an LP alongside us is a great way to go.
Yeah, I completely agree with all that. I think we have a pretty robust co-investment program as well. Actually, most of the deals that we've done have far exceeded the size of our fund. And so we've had a lot of supportive LPs throughout the process.
And Karen, did you have any thoughts about how deal making has changed more broadly, given that we're operating in a more high valuation environment? I know you touched on that a bit in your discussion about co-investment opportunities, but I'm curious, when you look at the relationships that you have with GPs, has that changed in terms of the criteria, the screen that you're putting towards them when you're evaluating investments?
Yeah, I would say we've tended to always favor sector specialists, and that probably holds true today, just because, again, given the environment, we think that GPs with strong sector expertise can probably have a better judge of quality of the businesses they're investing in, and hopefully then have lower loss ratios, which is obviously what we're concerned about given the high entry prices. We also look for managers that have a unique sourcing advantage. For example, GPs that are building strong relationships with founders or management teams over several years prior to investing, or doing deals on a bilateral basis, versus those that are sort of rushing through processes. We just think the quality of diligence is probably higher when it's on a bilateral basis, and then again, sort of just trying to mitigate mistakes on the way in, because we can't rely on that expansion on exit.
That dovetails nicely with what we were discussing earlier about both Miguel and Robert's sector specialization. I also wanted to talk a little bit about SPACs. I feel like no panel is complete in the current environment without their bemoaning their sudden disappearance from the stage, or speaking about how they provided potentially a lot more exit options for private equity as well. I'm just curious, high valuation SPACs as being potential additional conduit, another source of a bidder pool. What is the impact in the current environment? Are you seeing we start with you, Miguel.
Yeah, sure. So I mean, I think we've seen it on both sides, which is Motive has our own SPAC And we've also seen potential exit opportunities for our portfolio companies via SPACs. The one that's probably most relevant to speak about, though, is our own SPAC, which is slightly unique in the sense that our fund is also going to be an investor in the PIPE. So there's a bit more exposure from a private equity perspective to our SPAC, which we initially thought would put us at a bit of a disadvantage with high quality assets, because we have a return threshold on the fund that we have to meet that would likely limit the valuations we can pay for certain assets. But in reality, the struggle in the PIPE market has actually been slightly helpful, because you'll see the SPACs that bought assets for extremely high prices but don't necessarily have the relevant experience in that industry to provide value to the asset, or maybe isn't trusted by the market to have identified the right one, has struggled in the public market. So we actually think if there's a strong case for value add by the sponsor, and there's some validation that the sponsor knows the industry really well, it's actually improved PIPE execution and stock market performance. So in a way, the reckoning of the SPAC market has actually been pretty helpful to us in Motive's pitch for the assets that we're looking for.
Fair enough. We'll see shortly if you're alone in that assessment. Yeah, Karen?
Yeah, I mean, from our perspective, we're definitely seeing in many cases SPACs are paying a significant premium to other sources of liquidity in the market, and they're often acquiring businesses that have been difficult to sell through other channels. So while we do think some SPACs are doing sort of sensible and interesting things, there are a number of things that we've seen. We've been very surprised by the prices being paid. But I guess on the positive side, as Miguel said, we've seen a lot of SPAC interest in our portfolio companies, so it's a good exit path for us as well in the current environment.
I'll just chime in at the end here. We do not have a SPAC. I think that our companies 80% of the time we're selling to strategic buyers, full cash deal at closing, and so the public markets have not been appealing to us. You're looking at companies between 100 and 200 million of revenue in the consumer sector that never would have been candidates for IPOs are now interesting for SPACs. The challenge that we're having is that we're getting better valuations from strategics, from the better companies in our portfolio, and those are the only ones that the SPACs are interested in. Growth is very much at a premium. That's what they're looking for. Companies that maybe have slowed down a little bit, they're just not that interested in. And so it's just turned out to not be that relevant to us. There may be a handful of opportunities down the road for exit, and we're certainly exploring those, and we hear SPACs, but they all want the companies that we think we're going to sell for 25 times EBITDA anyways and get all cash at closing. So it's a mismatch, at least as far as our portfolio is concerned in general.
Well, thanks for giving us a lot to think about. Certainly, there are a lot of different ways to be more differentiated, sounds like, for financial sponsors in the market, looking for opportunities in a high valuation environment. And as a last resort, just sell to a SPAC. I think that's
sell to a SPAC and live with it, right? That's the beginning, not the end.
Yeah.
Well, thanks so much for your time. I really appreciate it. And hopefully, we can all catch up soon.
Yeah, absolutely. Thank you.
Thanks very much, guys.
All right. Take care.
Take care.